Dan, Nathan, can you believe it? It's early December. We're back again for the macro setup. This macro setup brought to you by our presenting sponsor, IGUS, one of the fastest growing foreign exchange dealers in North America. Dan, how are you, my man?
I'm doing great, Guy. Great to see you. And I just got to tell you, your New York football Giants, they were kind of tippy top of the NFC least for just a very short time. But I'm kind of with you here. New York strong. Okay, buddy?
Okay. Yeah, I know you're casting aspersions. By the way, the Giants have one of the top 5 defenses in the NFL. We'll talk about that later. By the way, we're going to be joined midway through by Chris Vecchio, senior FX strategist at Daily FX. Looking forward to what he has to say because foreign exchange has been a story. But before we get to that, Dan, obviously a lot going on in the world, broader markets. You know, what are you looking at? What do you find interesting on this fine day?
Yeah, it's funny. You know, you brought it in. You said we finally got here. It's early December. There's been just the news flow on so many different levels all year long has been like kind of coming out of a fire hose here. We thought after the election that things might slow down a little bit, but there's some massive macro topics still going. I mean, obviously, most of what's driving risk assets right here is related to the virus and the kind of economic impact of mitigation attempts. I know that right now, obviously, there's a ton of optimism about vaccines. We know in the UK, they just inoculated their first citizen with the Pfizer vaccine, which went live. It's going to go live here. We just had the FDA give some safety commentary, so we should expect the vaccine in small amounts, getting to our first responders, that sort of thing, essential workers. You know, that's great for economic optimism, but at the same time, we have this virus raging all over our country and much of other parts of the world here. And so it's going to be kind of a push and pull, right? We know that monetary policy is going to stay very easy for a very long time. We know that there's an ECB meeting coming up. I think as we turn the page on the calendar, we're going to start hearing a lot more what the Biden administration and how they're going to be working with the Fed and the Treasury Department to kind of push forward some further fiscal stimulus. That seems to be the thing that equity participants here in the U.S. are really waiting for.
And I understand optimism, and we actually talked about this on Fast Money on Monday night. You know, I think everybody is inherently optimistic. I totally get that. But optimism can't be a strategy, and you can be optimistic. And to your point, we had a conversation last night. You also have to be realistic as well. Yeah. And the reality is, although maybe by June of next year, you know, we'll have a significant portion of the population vaccinated, and this might be in the past, as the song goes, you can't get there from here, or there's some sort of Neil Young song, I'm sure. So one of the music bands that you like that speaks to that. And there's a long road from here to there. And in my opinion, and maybe I'm incorrect, but we've priced in so much good news and so many things have to go almost to the T for us to get there. It seems unrealistic to think that's going to happen. And we have a lot of analysts. This is the time of year when analysts give their forecast for 2021, the S&P outlook. And I think in terms of the main analyst, Tobias Lefkowitz at Citi, is probably low on the street, but he still has a $3,800 price target for the S&P. And I've seen things that go up all the way close to 5,000 on the S&P. And I guess my point is, look, we might, this time next year, we might have an S&P 5,000. But where do we go before that, I think, is a key. And we're going to speak to some charts. But again, a lot of optimism baked in, and that's manifesting itself in a VIX. And we'll talk to that as well, hovering around 21 or so.
Well, let's do this. Let's look at the S&P chart here, the 1 year, the S&P 500. I'm going to do a little theme here. It's going to be Top Gun. You know, you just mentioned Neil Young, but I'm going to go Kenny Loggins on you. I'm going to go into the danger zone here. But right now, I think you see a sort of S&P that's kind of got a little take my breath away, if you will. You know, we broke out above that 3,600. That was the September 2nd high here. And really, to your point about getting there from here, look at that volatility. Let's take out the crash in February and March. Just look at the volatility in the fall in September. A lot of that had to do with the election, had to do how we were doing with the virus, what the vaccine timetable looked like. And once we kind of got by the election, it's just been straight up. We know the S&P 500 has gone from basically, just above 3,200 to where it is right now, just below 3,700, and what feels like a bit of a straight line here. Let's talk about the danger zone. To me, is really that 3,400 to 3,200 level. The 200-day moving average has been creeping up. It's getting closer to 3,200. That should be pretty excellent support, suggesting, that, I guess barring any real hiccups with the vaccine, and with a timetable towards a back half of 2021 that we have our population inoculated, that should be really good support in that 32 to 3,400 level. That being said, the green area that I have shaded between 3,400 and 3,600, to me, that seems like a really great level where if you're bullish on the markets for 2021, but you think that the first half of the year might be a little bit rocky, and you also think that we pulled forward a lot of performance just in the last month or 5 weeks or so, then you want to see it come back into that level here. You want to stay above the hard deck here, but somewhere between 3,400 and 3,600 makes a lot of sense, setting the stage for a move into the back half of 2021 when we have the virus in the rearview mirror.
You threw in at least 3 different Top Gun references here. That is tremendous. And listen, for one, I don't know if I'm going back to a cinema anytime soon, but when this next Maverick movie comes out or when it comes out, I am all over that because those movies were badass. And my sense is, I'd like to think of myself more as the Val Kilmer in that movie, but you were clearly, if you had to sort of cast yourself, you're sort of the Tim Robbins of Top Gun, I would think, Dan.
No lines, not doing anything particularly important or anything like that. I got you, Guy. Well, let's do this. The S&P 500, you agree with kind of those levels, and you agree that, and then a pullback at some point into that 3,400 range might be very welcome by a lot of investors looking to reload. But let's talk about, what does the VIX mean to you? You've really had a good beat on the VIX here. And are we starting to see the fact that it caught some support at that kind of 20-ish level and we're kind of dying out, or at least the rally is petering out? Does this all make sense to you? Does it line up?
Well, I didn't think, again, I want to be somewhat honest here and talk about, I never thought we'd see the 21 level again, at least in the near term. And here we are, bouncing up against it. But to your point, this has been support on a number of times. And if you just go back to February, this is where we exploded to the upside from. Now, I didn't think we'd stay at 40. That was correct. But, I thought we'd sort of bottom out in the mid to upper 20s. And here we are. But again, the level of complacency in the market in sort of the wake of, or sort of in facing all the things that are ahead of us, is staggering to me. And I think it comes down to one thing. I think there's this belief in the marketplace that Fed, central banks globally have our back. And maybe it is that simple, Dan. Maybe I try to make this more complicated than it needs to be. But I do think there's a price associated with it. And I think the market is sort of, in layman's terms, sort of whistling past the graveyard here, because again, there's so many headwinds to me over the next 6 months that the market just is looking past. And I don't think you can do that. And for the people that say that earnings don't matter until 2022, I just think, I don't know, I just, that argument sort of, it falls hollow to me, and it rings hollow to me, because I think earnings do matter. And real quickly, because I think this is important to bring up. Yesterday, for the first time in history, global market cap of markets is now $100 trillion, and that's 115% of global GDP. And he said, well, what, it's just a number. It's meaningless. I don't think it is meaningless. And oh, by the way, S&P 500 market cap to GDP is either side of 180%. And just for context, Warren Buffett, who uses this as his major indicator, his level, his danger zone, and I think Warren Buffett is a big Top Gun fan, but his danger zone is somewhere between 125 and 130%. So we are well past the danger zone, and we're well below the hard deck here, Dan.
Well, there you go. You just kind of wrap that up. Okay, let's just kind of
on it for you. Yeah.
Let's wrap up the equity discussion with the NDX and NASDAQ 100, because I think it's really interesting. I know that there's a lot of strategists who really liked the broadening out of this rally over the last 5 weeks or so. You're seeing that some of the really hard hit groups, travel, leisure, some industrials, transports, energy, financials, really kind of participating, since the election and since the vaccine news. And we've also seen a really interesting thing where, my MAGA complex, that's the Facebook, the Microsoft, Apple, Google, and Amazon, which make up what, $7.5 trillion in market cap. You look at those and they've really gone sideways over the last month. So they really underperformed some of those other groups that have done pretty well. But the NDX, the NASDAQ 100, has finally broken out. You look at that chart right there, and you see it above that September 2nd high, and it's doing it without the participation of those massive names. That is fairly bullish, no doubt about it. You look at that uptrend, though, that line that I drew from the September lows, and you see to yourself, okay, we could do a little back and filling here, and that might be a great opportunity. If I'm looking at Apple and I'm looking at Microsoft and I'm looking at Amazon, they're actually really constructive charts when you consider how well those stocks have traded this year, up between, I don't know, like 40 and 70% on Amazon's case on the year. So a little consolidation there, I think, sets the stage for possibly a breakout in the new year of those names. And obviously the NDX is kind of be drawn up with it. I'm just going to make one last point about the NDX. It's about 22% above its 200-day moving average. Obviously, a lot of that performance of those massive names has done that. That's a pretty wide spread. So possibly, a pullback and then the breakout. What's your take on the NDX here?
Well, I never thought we'd get through those late August, early September highs of 12,400, number one. But, here we are. So bad for me. But, so much optimism, again, is baked into these names. And, you mentioned the FMAGA complex. You've done a great job. By the way, Apple's had this little stealth rally. And obviously, I thought, just to get granular, I thought the quarter out of Alphabet was extraordinary. I think that's a stock that can continue to do well. But one thing I would mention, because this is called the macro setup, and you have to look for things that can change the macro environment. And I think if you're looking for one thing in 2021, remember this, in my opinion: if ESG investing makes its way into one of Dan's MAGA complex, and my sense is the one with the bullseye on its back would be Facebook. Yeah. If you catch wind that, ESG investing is manifesting itself into Facebook, that could be extraordinarily deleterious to those shares. So be on the lookout for that. And I don't think it's that far-fetched. One of the things I said for a while is the existential risk to Facebook is exactly that. And I think you're going to start to hear, I think those whispers are going to become roars in 2021. And if you're looking for something to derail it, it might come in the form of ESG, Dan.
Yeah, well, and it's not just Facebook; it's Google. And we know that the Justice Department, there's active suits going on, and there's going to be a lot of regulatory action on those names, and that could be why they are the poster children for the ESG going forward. It used to be tobacco, it used to be oil, that sort of thing. It's going to be data, user data going forward. And you've been all over that. That's a great one. Here's another thing you've been all over, and this is actually getting more towards the macro here now. The U.S. dollar and the weakness, you've been calling for it. You've been playing it. You've been kind of selling every rally here. We kind of made some new lows. We have a couple charts. Give us a take on the dollar as it relates to kind of, I guess, earnings and just economic activity and what it means for the stock market. But we're going to segue into some more macro sort of instruments.
Well, first of all, I'm not an economist. As I say often, I'm not smart enough nor humorless enough to be an economist. But what I will tell you is every rally, in my opinion, in the U.S. dollar needs to be sold. And you go back to March and you look, the move in March to that huge upside move you saw was a flight to quality. And you see how short-lived that was. And that was on the back of it, global equities falling apart. And we don't really seem to be on the verge of necessarily that. But if you look since then, all the rallies in the dollar have been more shallow and more shallow. And I think that's going to continue to be the trend. Now, what you'll hear a lot from the pundits and people that come on the television and talk about these things is that the short dollar trade is an overcrowded trade. And I understand what they're saying. There's so many voices now that are speaking to the weakness in the dollar and their view that the weakness will continue. And I think Citi, as I've mentioned a couple of times, Citi put out a note a couple of weeks ago suggesting a 20% decline in the US dollar in 2021. I happen to agree with that. But just because everybody thinks something's going to happen doesn't mean they're necessarily wrong. Sometimes, by the way, the herd can be right. And I think in this case, they are. So, in my opinion, any strength in the dollar should be sold. And oh, by the way, dollar weakness in the wake of bonds going lower or rates going higher is somewhat counterintuitive. And that speaks to, in my opinion, a bit of an unhealthy brew. And I know we've had people on that said the contrary. We had Peter Bookvar on that said that's not necessarily a bad thing, and that's what makes markets. But I think if you see continued weakness in the dollar with rates going higher, something doesn't mesh up. And we're going to have Chris Vecchio from Daily FX in a minute to talk about exactly these things. But in my opinion, dollar weakness will continue. Dollar strength should be sold, Dan.
Yeah, so we have a 6-month chart of the DIX of the U.S. dollar index. We know that a lot of that is the euro, and we're going to get to the euro with Chris in a minute here. But just if you're looking for levels, that kind of just above 92, that breakdown level from the, August, September lows and then the early November lows, you mentioned that you're seeing these shallower rallies, or you could just say they're kind of a series of lower highs, If you had a sort of 1% rally that gets you back to that breakdown level at 92, that could be a good level to kind of lay shorts out again if you think that the trade is getting a little crowded, because we do know, especially in things like currencies, they just don't go in a straight line. That move that you talked about in March was a pretty extraordinary move for a currency. And then just real quickly, you've spoken to this 5-year Dixie chart guide. You want to just kind of get in there and update that. We're below, some kind of key support, which was that late 2017 low that it ultimately broke down and went much lower in early 2018. How are you seeing this trade play out? If you were to kind of reload on the short side near 92, what are the levels that you're playing for on the downside?
I think you bring up. I'm glad you brought this chart up, because to me it's pretty clear that we've breached that level of support, and I think the early 2018 low, which I think was in February of 88.15, 88.20 or so, is absolutely in the crosshairs. And then we'll see what happens when we get there. But my sense is it's not going to be pretty. And if you just go back and look, for you armchair technicians out there, you have a major double top in the dollar. If you go back to the late 2016 high, obviously the high we saw in March, I mean, that's textbook, folks. And I think that's going to hold up for the foreseeable future. And again, I think you're going to see that 88 level for sure. And you know what? When we get there, it might not hold this time, and it might get really dicey very quickly. I think, the dollar, to Dan's point, never makes a straight line. But over the course of history, you've seen these, what we call in the business, line jobs. You saw it in March, and I think we're on the verge of one again. And for you folks out there that think somehow a weaker dollar is bullish for equities, I think that's true until it's not. And that's not meant to be glib. But I do think a falling dollar at a certain point, you hit those diminishing marginal returns. And I think we're precariously close to that. And again, that coupled with rates going higher is a witch's brew, in my opinion, Dan, Nathan.
Yeah, so speaking of line jobs, let's go to gold, something you have been bullish of. I drew a line on a 1-year chart, and it's really fascinating, when you look at that breakout level from June above, I don't know, it was probably 1770 or something like that. And went straight, above 2000 here. And we've been in that really sustained kind of, downtrend. But where did it stop last week? It stopped almost to the penny of that May high, June breakout level, just below, 1770 or something like that. Pretty fascinating here. I'd love for you to kind of update your view. I know that you did not expect that sort of movement back towards the breakout level, but you got it. It held, and now we have a kind of a new test of that downtrend. What is your take on gold here?
Yeah, and again, you're right. I did not think it was going to get as low as it did. I actually thought it would hold sort of the 1800 level, which made sense to me. But I understand what's going on. A number of obviously things happen. I think the rally in the equity market sort of derailed gold for a period of time. And by the way, and we had Brian Kelly on a few weeks ago. Yeah. I think the move in Bitcoin, now we can argue whether or not it's justified. It doesn't matter. But I think the fact is, the Bitcoin move to almost 20,000, I think derailed gold as well. Again, I think the two are completely different instruments, securities, and I think people are looking at it incorrectly, but the market does look at it that way. And oh, by the way, Bitcoin at least for now, seemingly has topped out. You've seen some weakness around the prior all-time highs we made 3 years or so ago. I think that's coincided with this renewed interest in gold. And I think that's going to continue. To me, gold is simple. It's a play against fiat currencies. It's a play against a weaker US dollar. I think all those things will come to fruition. And I think, in my opinion, I think you're going to retest or test, I should say, those highs we saw over the summer. So I don't think the gold trade is derailed at all. If you watched Fast Money last night, that be Monday night, Mike Coco Beware came on and talked about the unusual activity he was seeing in Newmont mining. And you've had this huge stealth rally in the mining stocks as well. And you've seen a huge rally in the resource stocks. And I think it's just a matter of time before gold recaptures those highs, Dan.
Okay. All right. I mean, listen, I didn't mean to make it sound like you didn't,
No,
you were getting trounced on. You've been pounding the table all year on gold. So, I mean, you're going to have these sorts of moves. And I think for, the viewers of this podcast, I mean, when you think about it, you want this sort of volatility, and we're drawing the lines because they're basically giving you the levels where you think that where support should come in and where you might see resistance. You look at that 6-month chart and you look at that downtrend, there's a little bit more room up to possibly 1950 or so. But at that point, you better have a bullish thesis of why it's going to break out and get back above 2000, or you might see that rejected. All right. I think it's time.
Now, hold on. Before you do that, nice job shading that. That's wonderful. That's great technical work by you. Each week, you seem to get a little bit better. And, I just, since we seem to be bringing up references in this week's show, I would just say for those playing gold from the short side, be careful. You might be, wait for it, Dan, trampled underfoot. You like what I just did there?
I do like what you did there. I think the viewers are probably sick of hearing us. So maybe we could bring somebody in who's a bit smarter than us.
Then bring them in. Introduce them.
Well, you got it. It's Chris Vecchio. I'm told that it's not Christopher. That's only when he gets in trouble here. So hopefully we won't have any kind of chart fouls and we have to call him Christopher, but obviously a senior strategist at Daily FX. Chris, great to have you with us.
Thanks for having me, Dan. Thanks for having me, Guy. I thought I was in trouble during the setup because you kept calling me Christopher.
Right. Well, listen, you probably heard us talking about the dollar, and that was probably a pretty good segue for some of the stuff that you're most focused on. Do you want to give us your sense of kind of the way we drew some lines on the Dixie, the way we're thinking about the dollar? And then we're going to get into some crosses, but we're going to also talk a little bit about oil, some of those kind of commodities that are obviously the dollar's very kind of impactful on. But just give us your setup on the Dixie, and then let's kind of hit oil and some of those crosses.
Sure. Well, I'm very much with what you guys have been saying so far. And to keep going with the Top Gun references, the Dixie's lost that loving feeling, right? Losing that uptrend from the 2012, 2018 swing lows there is a major impediment for any bullish narrative that wants to come together. And moreover, we do have this real fundamental narrative driving this breakdown, which is the decline of real yields in the United States. With the Fed keeping rates low and deficits going up, we do have this instance where break-evens are running higher. Even with the vaccine development, break-evens are running higher. And unfortunately, Treasury yields are not keeping pace even with their rise. I do find it concerning, as it's been pointed out here, that we're seeing a currency go down in value while sovereign bond yields go up. If that was any other currency except for the US dollar, we'd be talking about what kind of issue they're going through. I mean, that sounds like what the euro went through, right? Italian yields go up, the euro goes down. So I do think we need to keep an eye on that. And I think we need to keep an eye on that because we're beginning to enter a period that's reminiscent of like 2009 to 2011, where we have growth on the horizon, low interest rates, and deficit spending. And that's when we saw the run up in gold. We saw the run up in silver, crude, copper. But then we did have a US debt downgrade eventually come at the end of that trail. And that was August 5th. I remember that because I was sitting at the bar when the Bloomberg headline flashed across the screen and bright red came. We had those 4 consecutive days of 5% moves in the Dow. So that to me still needs to be in the back of traders' minds right now. But the dollar, this environment's not going to change. Fed's keeping rates low for a long time. And if the Georgia elections do for somehow reason turn out to give the Democrats a 50-50 split with Vice President-elect Kamala serving as that swing vote, then you could see more stimulus, which at the end of the day, that's been good for gold the entirety of this year.
Yeah, it's interesting. And before we get to an oil chart, and Chris, I want to ask this because it's interesting. You mentioned 09, 10, 11, and sort of the similar setup. at what, I know you're not an equity guy, I'm not trying, but you can also obviously clearly watch equities from your 30,000 foot perch. Does it make sense that this would be a bullish scenario for equities, or in my opinion, is this sort of the witch's brew for equities that nobody's paying attention to?
Well, equities benefit environments with negative real yields. Real estate benefits, precious metals benefit. And so with that backdrop, it kind of feels like we're entering that conversation we had during those years where it says, well, when does the music stop? When does the Fed take away the punch bowl? And as we know, the market can stay irrational longer than many can stay solvent. So depending upon your time frame, like someone like myself who's just in his early 30s, I'm not cashing out tomorrow. I'm retiring in 30 something years, and hopefully sooner. I mean, if things work out. But I'm still thinking about where the valuations stand. Today, CAPE ratio is exceptionally high, up in the 30s right now. That's a concern. But if we do see the economy come back and we do see a picture of, say, earnings catch up next year, simply put, prices can run higher as long as earnings run a little bit faster. Valuations can come down. I do think with negative real yields on the horizon for the foreseeable future, it pays to stay long equities.
Yeah, it's fair. And with that said, I think the commodity that sort of is the poster child for global growth or economic recoveries is crude oil. I know we have a crude oil chart here, and I know we're going to get into some currency crosses sort of on the back of this view. But you look at this crude oil chart, Chris, is it telling you anything in terms of where we are globally, what's crude's going to do, and what it potentially can mean for currencies that are affected by it, like dollar Canada?
Sure. This flagging after the breakout attempt here is usually a strong technical signal. But we do need to contend with the fact that there is still significant supply overhead. OPEC Plus is cutting right now at 8.2 million barrels per day. That's going to shift lower to about 7.7 million starting January 1st, running through March. But we also know from the Dallas Fed survey that just came out a few days ago that we are looking at a scenario where we could easily see more production come back online in the United States if prices continue to climb. The shut-in rates for most of the major shale fields in the U.S. are $23 to $36. The new production would come in somewhere between $46 and $52 per barrel. And so from my point of view, we're nearing the top of a range. We could probably climb a little bit higher from here into the low 50s, but beyond that, it seems like it's a little bit of a stretch.
So, Chris, we zoomed in on this 6-month chart. You see that breakout above 44. And you mentioned that flag here. It looks pretty bullish, the ability to kind of consolidate here, even with all these expectations of more supply, kind of bullish here. Let's zoom out, though. Let's look at the 5-year of crude, and you look at that downtrend that it's been in since the 2018 highs. You connect the dots to earlier this year or late last year, and you get a lot of overhead room. If you're going to use that kind of low 40s, this breakout level around, or mid to low 40s around 44 as support, you got room into 50, 55, that sort of thing. And you really start contending with that technical resistance from that downtrend in the high 50s. Is there a scenario where you can see crude just ripping up to those kind of resistance levels?
Unfortunately, with the supply-demand deficit that's currently in place globally, and given how much can come back into the picture, I would be surprised if crude were able to run away like that without some significant adjustment by OPEC Plus. That said, the market can move quickly, and if we do find ourselves trading through 60, it would also mean that we're likely seeing a number of other things happening in the market. Global growth is picking up faster than anticipated. There's probably some rationale helping drive that. I would not dismiss that happening, but right now in the very near term where we still have all this uncertainty, still with the 7.7 million barrels per day that's going to be in the first quarter off the books, it just seems very difficult to sustain a rally without another adjustment by OPEC Plus.
As they say in Match Game, slide it, Earl, in terms of the next chart. It's interesting to go from oil to Earl, but for you folks, you Gene Rayburn fans out there, you know what I'm talking about. But just in going, that last chart, I just want to mention because it's worth mentioning. Obviously, that chart is skewed by that ridiculous move we saw earlier this year when the front month of crude went negative. So I know we can't back it out, but that chart would look much different, I think much more stark if that were backed out. Anyway, I just bring that up just for point of reference. And I think Dan draws a great downtrend line. And, you could still be in a 1.5 year, 2-year downtrend and still trade up to close to $58 or so in terms of crude. Anyway, I just wanted to point that out. So the next, Chris, is U.S. dollar Canada, basically. And that's an interesting chart for a lot of traders out there because this is effectively a lot of it's a play in commodities and all different things. But again, very significant downtrend since March. You look at this, what is this telling you? And is this a precursor for sort of a dollar move?
You know, I really like a lower dollar CAD right now. I've been writing about this for a few weeks, particularly post-U.S. election. Look, the United States is the world's largest economy. 70% of Canadian exports go to the U.S. 20% of Canadian GDP is derived from economic activities with the U.S. The U.S. is now regaining its economic potential because of the coronavirus vaccine development. But moreover, the trade barriers, the tariffs that were erected in the Trump administration are likely to fall under a Biden administration. It's going to be an easier path forward for the Canadian dollar, for the Mexican peso as well. If you guys were actually to zoom out on this chart, you'd actually see a double top forming in dollar CAD after breaking this rising trend line from the September 2012 low. I think the dollar CAD weakness is coming in, and much like the relationship between the euro and the pound, where you really see the two trade hand in hand, the Canadian dollar CAD tends to lead the rest of the dollar index. And so dollar CAD weakness here for me is foreboding. Even though it's not the largest component, it's only around 9%, it's still an important signal. It's the canary in the coal mine from my point of view.
Yeah, and it's a great police song. I'm sorry, Dan, but real quick, we do have a 5-year chart if you want to pull it up. Dan, go ahead.
Yeah, no, that was it. I was going to hit that same thing, and we see that double top over the last 5 years or so. I also think it's interesting why we zoom out and zoom in. I know, Chris, you are a slave to the charts like we are. You kind of see that uptrend from the 2017 lows. We broke that earlier this year. You see that late 2019 low. We're below that. We're just below every support level that you can see on a longer term basis, and it just looks like, you know, there's room easily down to kind of 125. Is that your near-term target here?
Yeah, absolutely. I think that this is not going to fall in a straight line, as it were, but there's a reason to sell every bit of strength in this chart.
Yeah, and I look at it and and I say, given my thesis and given my views in currencies, that 120, I think it was 120 and a half or so, the low back, and I want to say September, October 2017. That's absolutely in the crosshairs. To Chris's point, it's not going to happen in a week, and these things do not move in a straight line typically. But I think that's sort of what that's what you're looking for. So for your option traders out there, the binary players out there, I mean, if you're looking for levels, that's September. I see it on the screen now. That September 8th, 2017 low is one you should be looking at. So, and I think the next segue obviously is the British pound, and that's the next chart we have. Chris, maybe you can speak to what's going on here.
Oh, I don't think anyone can speak to what's going on here right now. Boris Johnson keeps moving the goalposts on whether or not a Brexit deadline actually counts or not. Listen, I say this somewhat cheekily, but these deadlines are, laws of men, not laws of nature. We're not talking about thermodynamics here. We can continue to move the goalposts, kick the can down the road until the deal comes into place. A worst case scenario for the UK right now in the pandemic is to have a hard Brexit where trade barriers go up, tariffs come into the picture. All of a sudden, this free trade, frictionless environment comes in, and the UK Office of Budget even is projecting about a 1.5% to 2% fall from GDP immediately if there is no deal. That's not something they can afford right now, given the fact that we're dealing with this pandemic. So it's really a volatile situation. We've seen a lot of whippy moves in the pound recently. I think the most interesting pound chart from my point of view is not necessarily pound dollar per se, although if there is a deal in any shape or form, given the background for more dollar weakness, and given the fact that the Fed is now the largest holder of U.S. Treasuries, I do think that falling foreign demand for U.S. Treasuries leads to more underlying U.S. dollar weakness. Pound probably continues to rise, even if we have this litany of issues surrounding a declining UK economy. On the other side of this, it's really asymmetric right now. If no deal emerges, which to me seems very unlikely, pound's going to fall, and it's going to fall hard. But the incentive for Boris Johnson to have no deal is very minimal and would only encumber his ability to stay in power now that we're actually past the 1-year mark where his party could call a vote of confidence. And so he messes this up with the pandemic, he could be on the ropes.
Yeah, so let's look at this chart real quickly. We have a 1 year, you see that uptrend that's been in place over the last 5 weeks or so. You saw that we had an intraday new high above 135 on a 1 year basis, fell back to that uptrend here. So you're thinking if we get a deal, you see this versus the dollar break out above 135. And then the other one, this 5-year chart is truly fascinating. We're zooming out here because you see that the resistance, at that 135 level is real. And then you see how steep that uptrend has been from the March lows here. I mean, this could be an epic breakout. Do you think you just keep kind of playing it off that uptrend on moves back to it and playing for a breakout above 135, a meaningful breakout that would make 135 support?
I do. Right now, I think in the very near term, you have to trust the pandemic trend line. And I think that we have to trust the fact that politicians will do the politically savvy thing, and that's cut a deal. It would be political suicide otherwise to let this happen. I know there's a part of the segment of the population that says no deal, doesn't matter, Brexit no matter what, but that would lead to the worst outcomes, and that would not lead to the Tory party's long-term success.
Okay, let's hit the euro. Let's hit the euro quickly here. We only have a couple minutes left, and we definitely want to get your take. This has been a chart that we've been talking about on the macro setup, a really nice consolidation versus the dollar over the last few months here. You see that uptrend over the last month. You see the breakout level, a little flag here. What's your take on the euro? We know there's an ECB meeting this week, and then we also have a 5-year of the euro.
Yeah, ECB meeting this week looks like a non-factor. I know there's been some commentary around Philip Lane and him giving privileged information to institutions. Perhaps that sidelines him. But the ECB is actually paying less and less attention to the dollar as the years go by. The Chinese yuan is now the largest component of the trade-weighted basket for the euro, and euro yuan hasn't really been going anywhere. I think that the ECB will tolerate a stronger euro in the very near term. Historically speaking, the ECB only gets ginned up about a strong euro when it's 5% or more above their effective year-end target for next year. That's 118. You slap on a 5% threshold above there, you're talking about 124 or so before it becomes problematic from the ECB's point of view, where it becomes worth them doing the job learning and spending that, a verbal ammunition on trying to talk down the currency. So I think euro dollar can climb further from here. In line with the dollar index, it's the largest component, 57.6%. Dollar index wants lower, euro wants higher. PBOC has incentive to keep the dollar going down.
Yeah, and I want to just put up the 5-year euro chart just so you have an understanding of where this can go. And Dan drew that horizontal line. You go back to the highs, I believe, in early January 2017. No, excuse me. I'm sorry, Dan. February 2018. My apologies. And you can see what we're looking at. And I think that came in around 125.5 or thereabouts. So that, I think, is your ultimate level, again, for you playing the binary options or the call spreads or those types of things. I think that level makes a lot of sense. And I want to talk about one thing we haven't talked about in the macro setup, and that's the Mexican peso, Chris. And you flagged this for us in our call. We have a chart here. Speak to what's going on and where you think things are headed.
Right. I think dollar peso has a chance to go lower. Some dust and grit has been put into the gears the last few days. AMLO has recently named this woman, Gomez, to be the deputy central banker. She's working at the Treasury previously, or was the treasurer of the finance ministry, excuse me. She has a little bit more of a dovish bend. And so the Banxico, which typically has a hawkish prevailing tone to it, now is going to have a composition of board members that may be a little bit more dovish. They could restart the rate cut cycle. That said, though, this is very much a more exaggerated story than the Canadian dollar. 80% of Mexican exports go to the U.S. 30% of their GDP is tied to activities with the United States. A restart of the U.S. economy is really important for the Mexican economy. It's going to lead to a lot of flows to the peso, which still has a very high interest rate, has a high inflation rate right around 3.5%, 4%, as the expected data is due in tomorrow. As far as I'm concerned, peso remains a target in the EM space for traders looking to get exposure here. And the downtrend is pretty clear from my point of view.
And just to give you context of where that downtrend could stop or where it's headed, we have a 5-year chart of the Mexican peso we want to throw up here. If you look, Dan drew a nice little trend line back from the lows of 2017, and you can see where we're probably headed. I try to eyeball it and figure it out, but you guys can do some homework on the back end to try to see vhere this is headed and where the ultimate support will be. Chris, thank you so much. This was really great. I think you did a wonderful job, great preparation. Chris Vecchio, Senior Foreign Exchange Strategist at Daily FX, will definitely have you back on, and have a great day. Thank you, Chris.
Thank you, guys. It was awesome.
So Dan, that was interesting. I mean, Chris really did a nice job for us. I think we threw out a lot of levels here. What sort of stuck out to you, and what are you looking at in the final minutes that we have?
I mean, listen, that theme of the dollar just kind of making, lower lows, and you look at the kind of bullish, I think, tailwinds that you have for the potential of the pound and the euro. I think that's a kind of interesting setup there. And there's plenty of kind of news pegs to keep an eye on, right? And the charts, we kind of laid out the levels there. There's plenty of stuff to trade against and kind of set your stops against too when you're wrong. And I know a big part of foreign exchange trading is really just being persistent, using those stops, taking little losses, right, and setting up for the big moves. And I think the pound appears to be setting up for that above 135.
Dan, I'll be your wingman any day, just to sort of put a huge bow on the Top Gun theme. Thanks. Listen, I want to thank Dan. I thought he did a great job. Thanks for being with us. Thank you, Dan Nathan, of course, at Risk Reversal on the Twitter. And I want to thank our presenting sponsor, IGUS, one of the fastest growing foreign exchange dealers in North America. Dan, this was fun. I'll talk to you next week.
All right. Thanks, guys.